and welcome to today's edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com. Our special guest today, Charles Nenner with the Charles Nenner Research Center. His website, charlesnenner.com. That's Nenner. Charles, welcome to the podcast today. Lots of stuff's been happening here just recently. We had the big sell-off at the end of 2018. We had the stellar rally for the first 4 months of the year on hopes of a trade deal with the U.S. and China. Of course, kind of a pivot by the Fed as well to being more accommodative. You just recently talked about going long the VIX in your research, suggesting that there was going to be a big pickup in volatility. Of course, that generally relates to downside risk in the markets. What caused you to make that call, and what are you seeing now?
The system that I developed says that nothing happens at random. That means we know if something takes up with a certain momentum, how high it's going. That means you get an upside price target, or if it goes down, a downside price target. And we also know when it's going to happen. So I built up a cycle a network that gives you the exact date that something's going to happen. So it was actually very simple. We had a cycle top already. We talked about it a couple of months ago on the 7th of May. The cycle top came in the 6th of May. And it goes down till the 24th of May. And we had a short-term cycle on the VIX with the price target around 2021. So we bought it, I think, around 13, and we sold it above 21. And the cycle is still up till the 20th of May. So the VIX could be on the high side for another week. And on the longer term, cycles are moving up, which means that these very low numbers, 9, 10, 11, that we saw in the VIX, we're not going to see for a long time. It doesn't mean that we're going to have a big sell-off. I still think that starting the 24th of May, we're going to have another move up, but we're getting close to the end.
Well, and when you talk about this, when we talk about cycles, there's very long-term cycles, shorter-term cycles. So when you start doing your cycle research and start talking about these cycles again, talking about this particular cycle when ends on the 24th, the next cycle starts. How long does that last? And I guess really for the big question for investors, we've been in a 10-year bull market now. So when we start looking at long-term cycles, what are you looking at in terms of a cycle, potentially a cycle top for this decade-long bull market?
Well, we went out in January 2018, and I'm going to tell you, and it sounds strange, but it's really one cycle. Every time that the year ends with a 7, you come to the end of a bull move. So that was 2017. That's why we got out at the beginning of 2018. If you go back 10 years, then it's 2007-8. Well, everybody knows what happened over there. Before that is 97-98, the Asian crisis. 87, I don't have to tell you what happened over there. 77, 67, 57, up to 1937. So that's for instance a long-term cycle. It's very simple. Just most people don't get there because they think anything can move the market, so they never look for any patterns in the market. So that's a long-term cycle.
Right.
Usually I work with cycles that are weekly cycles that project out, let's say, 2 or 3 months. And they project till after the summer. And after the summer, I think the bull market is going to be finished. And one of the reasons is, and this is also something you won't hear very much, is that I think we're going in deflationary period again. And nobody's prepared for this.
Well, that's an interesting comment because that's something that, we've talked about for a long time. There's been a lot of talk over the last really 4 or 5 years about how interest rates are set to rise because simply they've been low for so long. And our argument has been, well, rates really can't rise for a lot of reasons, but one is primarily the amount of debt we have in the economy, which is very subject to changes in interest rates. But also the bigger issue is this ongoing rise of deflationary pressures that continues to apply to the market. So when you start talking about the risk of deflation, later this year, I think that's a very valid point because we see a lot of those pressures now.
Yeah, it's just that most people who don't study the history of financial markets remember that there was always a story about inflation for the last 30 years.
Yep.
So most people only know about inflation. They don't have no idea what deflation does.
Right. One of the ongoing, I guess, arguments, for the never-ending bull market at this point has been really the impact of the Federal Reserve and central banking, not only domestically but globally. Does that in your opinion, and based on your investment cycles, does that impact of liquidity from central banks, does that potentially extend a cycle longer than normal?
Well, let me give you an example. There was a high inflation rate in the early 80s. I think interest rates even were 16, 17, 18%. Then came Mr. Volcker, and he so-called killed the inflation. Forgetting there's a 30-year cycle of inflation deflation, and based on my work, it doesn't matter who would have come there, the inflation would have been over anyway. So I do my work not counting on the Federal Reserve. The Federal Reserve is part of the market. And I don't see the Federal Reserve as a sort kind of Freudian father figure who's going to take care of us. So I don't think the Fed can influence anything, and otherwise I could forecast anything because who knows what the Fed's going to do. But the Fed is as predictable as the markets based on cycles.
We're going to take a quick break. We're going to come back more with Charles Nenner right after this break, talk a little bit more about the markets and cycles and what he sees coming down the road. We'll be right back more on the Lance Roberts Show podcast right here at realinvestmentadvice.com with Charles Nenner. Don't go away. Welcome back to today's edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com. Our special guest today, Charles Nenner with the Charles Nenner Research Center. So, Charles, just before the break, we were talking a little bit about, kind of what your cycles are currently predicting. I do want to get back to talking more about market forecasts because that's obviously important for investors. But I think what individuals need to really understand here is kind of how your system of cycles works and, how do you come to your conclusions? Can you give us a little bit more depth into that?
Yeah, I start with what I saw. I saw Professor Shiller, who is the big professor who wrote about fundamentals for years. Mentioned him on CNBC that his next book is going to be about narratives because he now decides that narratives move the market. Well, I know that already for 30 years, and the next step is, which he doesn't talk about, how do you know which narratives are going to come up? Now, this system was used by Goldman Sachs to invest their own money for many years when I was at Goldman Sachs. So it's an old system that is still doing very well. I give you one example. Let's say you own IBM, and IBM has up 50% in a year. And IBM comes out with a great number. Now, the question is, does IBM go up or down? Well, if the cycle is up, then IBM goes up, and the Wall Street Journal will write, people poured into IBM because they've got great results. So what do you do if the results are great, but the cycle is down? Now IBM goes down, and now the Wall Street might, or another paper might write, people to profit because they don't think that IBM can do better next quarter. Which means is that the interpretation of the fact most of the time is more important than the fact itself. And the cycles are based also on mass psychology, and they can predict what the interpretation of the facts is going to be once they top or they bottom. So that makes investing very easy, and it takes out a lot of risk and emotions because you don't even have to look what the numbers are. You just have to know how it's going to be accepted in the market.
Well, I think it's a great point. One of my favorite stories, talking about IBM of all time was I was driving to work one day, and IBM lays off 5,000 employees, and the stock is up in the morning because, well, they laid off 5,000 employees. By the afternoon, IBM had rolled over, was negative, and it was negative because they laid off 5,000 employees. And I think that's the biggest problem with most investors is that we do get tied up into headlines. We do get tied up into the immediacy of the market, and we do forget to step back and look at, longer-term pictures, trends of the markets, kind of where prices are headed and psychology. And so when you start looking at these cycles, what time frames are you looking at here? Are you looking at monthly, weekly? How far out do you look?
Well, we have an intraday service that's even more interesting. So we can tell you if an S&P goes down or up, how high, and what time during the day is going to top or bottom. And sometimes I put CNBC on, and it's always an item that corresponds with the fact that now the S&P is turning around or turning up.
Right.
So it's something I see on a daily basis. So the shortest term is our intraday update during the day. Then we have a lot of pension funds, especially in Europe. They can only move once so many years, and they have to have meetings in order to decide what they're going to do. So they need far in advance, half year in advance to know what's going on. So we do it longer term, which are called yearly cycles, quarterly cycles, monthly cycles, up to the intraday service that we have.
Interesting. Well, I guess for most investors, when you think about most investors, they are, typically working individuals or putting money in the market. They're kind of hoping it's going to grow over time. So when they're looking at their portfolios, what would you recommend for the average person? Kind of a monthly cycle or something shorter or longer?
Well, it depends how most people work with weekly cycles, which means is we take a position in a stock and keep that usually for 3, 4, 5 months. And then we have a certain price target and a certain week that it's going to top, and then we go out and then we look for another opportunity.
But even a weekly cycle is short for a lot of individuals. So when you start looking at longer-term periods of investing horizons for individuals, wouldn't a long-term cycle work?
Yes, but there's something that the most people on Wall Street give the right information about. Because if you talk to pundits on Wall Street, they say, well, the markets usually go up 8% on the average, which is correct. If you go from 1900 to now and you draw a line with an angle of 8%, the average is 8%. What they forget to say is that now we're about 50% above the 8% line. So in order to get back to 8% on the average, we have to go down below the line 50%. So for long-term investors, you really have to understand where markets going longer term, and you don't want to buy in a market that is overvalued, in this case, for 50%, and has to go down to minus 50% in order to have an average of a growth of 8%.
See, I think that's a fantastic piece of advice. It's what we talk about a lot. Is that when you even just look at a picture of the market, it's always interesting to me that people do say this. Say, oh, just put your money in the market. Long term, you're going to get 8% a year every year. And that's what's implied by when you talk about average returns. But even if you just look at the market over just the last 18 months, clearly markets just don't generate 8% a year. And it's the variability of returns over time that really impact wealth and the ability to accumulate, wealth over time. Because again, it's not just the variability of the return that impacts the growth. It's also the psychology of investors who are panic selling at bottoms and then trying to panic buy at tops. And that's, one of the things that I find fascinating about your work is that by applying cycles to the markets, and it was a great point you just brought up about being 50% above the long-term average, that there are points that simply having money invested in the markets is not going to generate the returns that people have been told that they're going to get. And that leads to a whole variety of other problems, from emotional mistakes as well as to investing mistakes.
Yes, so Marty Zweig, that was already a long time ago, always used to say the trend is your friend, and I say the cycle is your friend. As long as the cycle is up, even if you make a mistake, you're going to be safe because the cycle is up. But when a cycle is turning down, you better get out, because whatever can go wrong can go wrong.
Right.
So the cycle topped 6th, 7th of May, and suddenly we got the situation with Iran, we got the situation with Trump. If the cycle would have been up, people would say, it's not so serious, and the market would have gone up. So don't watch the news. You have to know what the psychological situation is of the market.
Right.
And if people want to see it, we give it out a couple of weeks for free, and you can see it yourself. And then for one time, you see how much knowledge there is on Wall Street if you really look into it.
No, it's actually a great point. I want to come back and talk a little bit about, now that we kind of talked about how the cycles work, I want to talk a little bit about what the cycles are telling you now, particularly as we move into the end of this year, 2019, and headed into 2020, what you might be seeing for the longer-term cycle of the market. We'll come back with Charles Nenner, the Charles Nenner Research Center at charlesnenner.com. You can get access to his information and his cycles. So simply go by the website, charlesnenner.com. We'll be right back more after this on the Lance Roberts Show podcast at realinvestmentadvice.com. Welcome back to today's edition of the Lance Roberts Show podcast at realinvestmentadvice.com. Our special guest today, Charles Nenner from the Charles Nenner Research Center. We're talking about cycles and markets. Just for the break, Charles, we were talking a little bit about, the cycle of what's happened here recently. Wall Street forgets a lot that, cycles do apply to markets. They do regularly occur in markets, just as we have seasons every year. The markets go through cycles, and you can't have one cycle without a corresponding cycle down the road. It's just, and Wall Street tends to forget that. We get into a bull market cycle, and they start extrapolating that the bull market cycle is never going to end. But for every bull market, you do have to have a bear market. And that's what cycle research tells you, right?
Yes, but just, the situation with the banks and brokerage firms, that how they attend to their clients is that they're afraid to sell. And then if it goes down, it says, oh, it's too late to sell now. And then when it's lower, then they start talking about buying opportunities. So when the market comes down and I watch the media, I never see anybody say sell. It's a buying opportunity, because that's how Wall Street works. It's always a buying opportunity. And I just don't think it's fair to the investing public. So the research that brokerage firm and banks give is a bit tainted. It's not like I work, because I don't care if the market goes up and down. The only thing I have to do is have to be right about the direction.
Right.
I don't have fun. I don't sell anything. But the media and the institutions are biased because they make money if the market goes up and people buy.
Right. Well, they have product to sell, and and if the market's going down, I'm saying, hey, you need to get out of the market. The market's going down. Well, I'm not making any money because I don't have anything to sell you. So to your point, the Wall Street media, et cetera, are all benefit by a bull market and rising prices because they sell product. And for investors, it works out great as long as markets are rising, just not so much when markets are falling. So we were talking about these cycles, and it's interesting because you made a point about cycles is that the markets will tell you that something is going to occur, and then it's almost, it's prescient to the fact that then a few days later, or a few weeks later, a few months later, then something will happen that will cause that cycle to reverse. And it was interesting because, here's a chart of the S&P 500 behind me, and just last week we were writing that in our newsletter that we were due for a correction in the markets. The markets got very extended. The current cycle had been fully processed since January, and we were due for a correction. And the next week, we get back into a trade war, which was completely unexpected because everybody expected a trade war to get the trade war to be resolved, between Trump and China. So it's always interesting to me is how markets predict what comes along or what will come, and then it's almost the environment fits into the schema of the actual cycle itself.
Yeah, but once you understand, then you can invest without making major mistakes. But it's against the philosophy of this world. So it's very hard for people to grasp this problem.
I absolutely agree. And because, it seems too complicated. I think is the big thing. Not enough people spend enough time understanding money to start with. Financial education is one of the biggest problems that we have in this country right now. And I think that when people look at something, you start talking about cycles and Fibonacci levels, MACD lines, etc., it gets so confusing, it gets so overwhelming. They're like, I just don't understand it. But this
it's much more than this, and I don't want to get in trouble. But I never saw people who talk about the climate problem looking at long-term cycles. So. You understand? So The question is are we on the top of a cycle that brings up the temperature and soon we're going to turn around or not? So nobody has any clue where we are. So it's not only about finance. I do it also for fashion. I work with big companies in Hong Kong who have to know what's the fashion in 2 years. So I look at the fashion of the last 60 years, single-breasted, double-breasted suits, whatever, which colors women are going to wear. And that's what we do. We work with the companies who have to bring out the CDs. Does it have to be a male singer? Does it have to be a women singer? Does it have to be in springtime, in December? It all is based on the pattern continues, but the problem is then we have less free choice than we want to have, and people cannot accept that.
So when are bell bottoms coming back in? I guess that's the real question.
Oh, I don't know, but keep them in your closet. It always comes back.
About every 20 years, isn't it? Going back to the market cycle where we are, we are going through this correctional process right now, and you're saying that basically this little sell-off that we're in right now will probably end, have a little bit of rally, I guess, going into the summer months. But, are we closer to the end of this cycle? And you alluded to this earlier. And if we are closer to the end of the cycle, later this year, going into 2020 because of a rise of deflationary pressures, what's making you see that now, and what do you think will ultimately cause that?
Well, we have a target of 3,050, 3,060 in S&P. So we have another, from the last high, another 60, 70 points to go. It's not that much.
Yep.
The problem that I see is that usually bear markets and recessions start from a GDP that used to be 5%, 6%, and inflation that used to be 3%, 4%. And now we have maybe 2% GDP and a very low inflation. So you can imagine if the economy turns down, it's going to be below zero. And I think it's going to be much worse than most people expect.
Well, and again, we were talking about this the other day. There's a lot of things that actually, portend to that actual position. We have a massive amount of corporate debt, record debt levels really pretty much across the board that are, provide the fuel for a bigger downturn. But I think the point you made is excellent. And I've talked about this a lot. And, when you listen to a lot of the media, they say, well, by the time the yield curve inverts, there's generally 20 months or, however long it is until the recession actually starts. So nothing to worry about between now and then. But to your point, historically, when the yield curve is inverted, GDP is running at 4.5% to 5%, not 2.5%. And so your time to recession is much shorter just simply because you don't have as much runway to go from 5.5%, 5% to zero, 2.5% to zero is half the time frame, right?
And there's another big problem. The last time there was relatively such a deficit was under Roosevelt. And because of the inflation in the 40s until the 50s, they only paid back like 10 cents on the dollar. But here, if we have no inflation, the Americans cannot get out of this debt situation. So it's going to be a huge problem. There are a lot of problems. But again, if the longer cycle goes down, then everybody says, how about this problem, that problem? We know about the problems, but nobody takes it seriously until the cycle tops, and then everybody comes up with why the market could go down, and it really goes down.
Well, so when you're looking at some bigger macro issues here about debt cycles and those type of things, so I guess this really brings up the question. We went through a big financial crisis in 2008, and it's interesting because I was listening to one of the Fed speakers the other day, and she was making a comment about the crisis, and she goes, the recent crisis, that was a decade ago. But, the scars from that crisis are still very real for many, many people. Do you think the next downturn in bear market / recession in the economy is going to be as bad as that, or will it not be as bad?
It will be worse. There is something that I call the super cycle that started like in the 17, 80, the first Berlin crisis and the 1929 crisis. And then we had the Fed, and the Fed decides we're not going to have a big recession, not a depression. We have all kinds of tricks. We take out the money supply. Then companies will get issuing stock, and then they decided in the 80s to issue only bonds. And we keep it going until we run out of ammunition. And now we're out of ammunition. So it's going to be much worse than in 2007, 2008, because there is no way of fixing it anymore. One time you have to let the whole thing collapse before you can start all over again.
That's a great point. Charles Nenner Research Center. We're going to come back, finish up our conversation with Charles Nenner right after this break. You're listening to the Lance Roberts Show podcast right here at realinvestmentadvice.com. And welcome back to the Lance Roberts Show podcast. You're listening here at realinvestmentadvice.com. Our special guest today, Charles Nenner from the Charles Nenner Research Center, charlesnenner.com, NENNER.com. Get by his website, check it out. It's very fascinating information there. Charles, just for the break, we were talking about this super cycle. People have heard about the contractive cycles. We've talked about macro cycles. We've talked about secular bull markets and secular bear markets. When you're talking about a super cycle here, how long of a time period is that normally?
It's not normal. It's not a real cycle. It's just when this whole expansion started late in the 19th century. Mm-hmm. And you see it developing with the different smaller cycles. And I call it the super cycle because I've been writing about it. We're getting close to the end. And there's not, like I said, there's not much we can do to fix it anymore soon because we keep it going as far as we can. Greenspan says, not in my lifetime. I don't want to be the one who brought it down. And then Bernanke succeeded in fixing it again. In the end, you can fix it again. and we're in for a very bad time.
Does that also coincide with the fact that we've got a demographic shift that's also occurring at the same time? I mean, birth rates, fertility rates in the U.S. are back to levels we haven't seen since 1940. We've got a shift in the baby boomer generation, stagnation in terms of employment and structural changes there. Does this all kind of play in together, or is it simply a market issue?
Well, we used to think like that, but if you take a look at Japan you don't hear about, is doing great, and they have, I think, one child per family, and that is really building up very nicely. Japan is actually doing the best of all the countries, although you don't hear about it. So it's not so sure that this is going to be one of the reasons. But again, my work is not why. My work is what's going to happen. And I just want to make one more point. Sure. That when we developed a system that says when is something going to happen, we also developed the system how high a stock goes. That means if IBM goes up for a couple of weeks, then we know till the end of the year how high it's going to be, and we get a price target that usually is going to reach exactly the price target. So then we know the day of the top of the cycle and the price target, which makes investing like a science and not like listening to media and reading newspapers and just seeing what the Fed does.
So, all right. So there's I guess the question. So how high can the S&P 500 go before we get to that point where we start talking about a crash?
Well, our price target was 3,050, 3,060. I think it went to 2,980 or so in the S&P. We could be up for 1 or 2%. So the next up move, if we correct starting late May, according to us, is going to be the last one. And as soon as we hit 3,050, 60, we're going to be totally out of the market.
Okay. And then how low does it go from there, I guess, is the real question. I guess that's the question everybody wants to know, right, is how low does it go?
It's going very, very low. I said it before. People can Google it. I'm not going to say it because people don't sleep anymore when they hear what I have to say.
So, all right. So Google CharlesNinner.com and how low will it go?
Right.
Is the Google search. Well, look, I think this is important, when we talk about this because, again, when markets hit an all-time high just a couple of weeks ago and everybody was all excited, markets hit all-time highs. We recovered from the disastrous December 24th sell-off, rallied right back up, hit all-time highs. And so everybody got excited. We saw equity flows turn positive. Investors started chasing the market. And what you're talking about here is that we're going to get a rally back to all-time highs, starting in, towards the end of this month. That's going to get everybody all excited again that this little blip was over with and, we're off to the races. But, that's the thing about bull markets and particularly bull market tops is they tend to suck in the most investors right at the end of the cycle. And it's just how markets have always worked, right?
Correct. And there are services that show you, they call it the clever money and the dumb money. And you see that every market top, the dumb money is buying and the clever money is selling. So I don't think it's just an intuition. I think the clever money really does their work. It's not like the media says, what does the Fed say? Because if you do your work, then you can calculate yourself what the Fed sees. But it seems to give you impression nobody is doing his work, so we just have to wait till the Fed opens their mouth. But as we know, markets actually move based on the news of next year. So actually you have to know the news of next year, and if you don't know the news of next year, then there's no reason to invest.
Right. It's a point. So, Charles, is there anything I didn't ask you today that you think is important for people to know?
No, but usually when I say these things and they don't lock me up in a psychiatric clinic, I already won something.
That's probably no truer statement right there. All right, well, that wraps up today's edition of the Lance Roberts Show podcast with our special guest today, Charles Ninner. Be sure and check out his website, charlesninner.com. It's the Charles Ninner Research Center. It's all about cycles and what happens in markets and why cycles are so very important to understand because, well, basically cycles apply to everything from investing to life to money. And, of course, it's all there to help you as well. So get by the website as well, charlesninner.com. And also, you can get this entire podcast right here at realinvestmentadvice.com. Just click on our YouTube tab. This entire podcast will be posted along with all of our other great interviews that we do every week. So enjoy it, and we'll see you next time on the next edition of the Lance Roberts Show podcast right here at realinvestmentadvice.com.
All the things I would do if I You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.